it may be that the Fed cannot solve this problem. So if I lay it out as a proper mathematical formulation, it may be that there's no solution. There was a solution when inflation was low and growth needed to be pumped. Now there's no solution because inflation's high, growth cannot be trashed too badly, and growth gets hit first.
Welcome to Real Vision. I'm Ash Bennington. I'm joined today by Harry Krishnan, head of volatility strategies at SCT Capital Management, for a very timely conversation about the Fed, inflation, interest rates, and recession risk. Welcome, Harry.
Well, thank you very much, Ash. Always a pleasure.
Yeah, it's great to have you back on the show. Before we start, two disclosures. First, a number of months ago, you called me up with this idea in what was still the nascent phases. You and I have talked through it a little bit before. This is not the first time we're having this conversation. Frankly, I found this idea incredibly interesting and incredibly timely, so I'm very happy to discuss it here with you today. And second, you and I obviously have written a book together, Market Tremors, Quantifying Structural Risks in Modern Financial Markets. And by the way, Amazon informs me it is the first edition, almost as though it is begging for a second edition to be written as an update.
God, we do go back a long time, Ash, so great to be back on.
So I teased it a little bit at the top of the show. We're going to be talking about the Fed, inflation, and recession risk. Give us a little bit of the market setup and the macroeconomic setup of where you see us, the economy, and financial markets at right now.
Well, that's an all-encompassing question, so I'll try and drill down a little bit and say that I think the Fed's view on inflation and the Fed's potential actions vis-a-vis inflation are driving the market. So the market drivers tend to change over time. Sometimes there are fears about a credit risk or various other things. Right now, we're kind of fully into the inflation fears versus deep recession fear paradigm. And I think that's why looking at the Fed funds futures, and looking at options markets related to them, to short rates, is kind of the crucial thing.
So let's talk a little bit about that. Obviously, many of our viewers will know that inflation is running incredibly hot right now. 8.6 print on the last CPI. We're filming here on Monday, June 27th, so the end of the month of June. A lot of consternation about rising prices in markets and in the broader economy. Give us a little bit of context for how you see that shaping up and what you see the potential impact being on markets and the broader macroeconomy.
I think the market's perceptions of what the Fed is likely to do are driving everything. And so having a good handle on that is perhaps the most important thing. And of course, we've gone from, let's say, as recently as June the 10th, a market that believed that the Fed would hike aggressively, as they did, and as they potentially would in September. And so there was a lot of discussion about another 75 basis point hike, to a more tempered view, which is kind of what I would have expected based on the potential impacts that the Fed could have on growth. Because remember that there's always a kind of not a double-edged sword, but a two-headed beast that needs to be tamed. One of them is growth and the other is inflation. And one of the main points I wanted to raise today, and I'll let you expand upon it, is that it's much easier, at least historically and cross-sectionally, it's been much easier to stimulate growth in a moderate inflation environment than it is to temper inflation in a sluggish or uncertain growth environment. And that's really the main topic I want to discuss today.
Yeah, that's really the core of the paradox that you've been working on and modeling and thinking through these last several months. Before we get into that, let me just give a little bit more background for those who are relatively new to macroeconomics, who may be struggling to understand this reaction function that we're talking about here. So very often you will hear the phrase dual mandate used in the context of the Fed. The dual mandate is the statutory mandate that the Fed has from Congress. And this is twofold. One, stable prices, and the other is maximum employment. Maximum employment is related to growth. And so when you talk about growth, we're really talking about this sort of two-sided piece of paper of growth and employment being positively correlated. So that's one side of the dual mandate. The other side of the dual mandate is inflation. Let's talk a little bit, particularly for people who are relatively new to this, Harry, before we get into the core thesis itself, about the history and the context of what the Fed has been doing. Obviously, the last meeting, 75 basis point rate hike. Give a little bit of broader context. Obviously, we've been in this incredibly low, ultra accommodative monetary policy space since the 2008 financial crisis period. Give us a little bit of context on what the Fed has been doing over that time period and how now it appears to be reversing because of the necessity of controlling inflation.
Well, first of all, I'll give a massive disclaimer. I'm not a Fed watcher. I mean, I do watch the Fed, but that's not my job. I'm also not a day-to-day macro person. But what I do have is a deep background in control theory and a pretty deep understanding of how delays or transmission lags affect important variables.
First, what is control theory?
Control theory, probably its heyday was in the 60s in the public eye when they tried to land rockets on the moon, or subsequently when the space mission was going strong. You'd have some little spacecraft or some big spacecraft who'd try and put it up into space, and you had to deal with it dynamically over time. So as conditions changed, maybe there were some winds, maybe things were going on that you didn't expect, you'd have to adapt to that. And so control theory is an attempt to reach a target or reach a destination by adjusting some inputs, so turning some dials. And so control theory you might not think has anything to do with economics, but I would argue it strongly does as soon as you start thinking of the Fed.
Right.
Now, whether the Fed can control, whether they do have dials that actually work, is another question. But I think for lack of a better word, the technocratic view of things is that these things, the dual mandate, can be controlled via turning dials. Now, of course, the two main monetary policy dials are adjusting rates, adjusting discount rates, and also, adjusting the size of the balance sheet through open market operations. But today I'm just going to focus on the first one, which is influencing short-term interest rates.
Yeah, it really is interesting, as you mentioned it, not being someone whose background is in macroeconomics, but in applied mathematics. Control theory, a subset of applied mathematics that thinks about feedback and complex systems and how those systems can get out of balance and the challenge of solving problems with complex systems with feedback.
Yeah, I mean, that's my paradigm. Of course, I am a macro guy now and have been for a while, but I always like to try and put things on a solid footing that doesn't require looking at what the jawboning of the Fed is, this, that, and the other. So, I mean, one of the big projects that I've worked on is trying to figure out trying to infer what the Fed's model or their mental model of inflation and growth might be based on what they've said. And that's going to be a big part of what we'll talk about today. And then I'll try and follow on with that with the ramifications of their worldview versus what could happen in markets. I will not argue that their worldview is correct, that it's incorrect, and I'll issue a spoiler, which is that I don't think it's as though the Fed can control everything. It's not as though they can engineer a soft landing. I think it's more a question of there potentially being no solution for the Fed when thinking about this as an engineering problem. And I think that's something I'd love to dive into while discussing the ramifications. So, yeah.
Well, I think we've done a good job of setting the table here in these first few minutes. Let's jump in. As you began thinking about this, what was the specific problem you were seeking to answer?
Well, the first question is in the sort of is summarized in the slide, how the Fed views inflation, which you can throw up there as you see fit. It's a bit wordy, and I apologize to the Real Vision viewership for that. But basically what it is an attempt to take a bunch of quotes that Janet Yellen has issued, a quote that Jay Powell has issued, and some analysis from the Czech National Bank and other bits and bobs, the San Francisco Fed, to try and arrive at some coherent model of how they view inflation without a value judgment, without saying it's good, bad, or without getting all emotional about it. And I think in 2016, Janet Yellen gave a speech where she said that there are three components to inflation. The first component is trend. That's a long-term thing. The second component is...
What is trend, Harry, as Janet Yellen used it in that speech, in your interpretation?
It's the long-term. By long-term, I mean the 1 to 5 year expected change in inflation. And the Fed's preferred measure is the PCE rather than the CPI, but it doesn't matter too much. As anchored by expectations. So the University of Michigan has an inflation expectations index over various horizons. And the belief is that if the Fed has solved the problem of inflation, as they have taken credit for many times, then even if inflation sort of pops up a little bit, oil prices spike, this, that, and the other, it's not a big deal because corporations and individuals won't adjust their behavior so much to the so-called transitory changes because they know or believe that the Fed will be able to adjust over time. So that's a bit of a confidence trick, but yeah.
So this first piece is the sort of longer-term structural rate that Chair Yellen was discussing.
Yes, and so moving from the longest tenor or the longest horizon to the shortest one is can be proxied by fluctuations in oil prices, commodity prices. And the idea there is that, well, if oil spikes, Fed doesn't have to do much because it's going to come down quickly. Market forces or, capital market forces will push it right back down again. So the real thing that the Fed on record has been concerned about is the output gap. Again, this is a thorny macro term, but what the output gap means...
And just to frame this is the intermediate term. So you've got the longer term trend rate, you've got the short term rate around commodities prices, sometimes called exogenous shocks. You hear about negative exogenous supply side shocks in the fancy economic term whenever you see oil prices spike. And now what you're dialing into is the medium term cyclical component of inflation.
Yeah, the cyclical component, as the Fed defines it, is related to something called the Phillips curve. What the Phillips curve relates is the output gap, which can either be interpreted as the level of employment or unemployment relative to target. There's some natural level that is God-given for employment or unemployment. It relates employment to inflation, or similarly, it can be used to relate excess growth to inflation.
So this intermediate term is all about the business cycle that we're talking about. We sometimes hear NAIRU, this is the non-accelerating inflation rate of unemployment, R-star, all of these terms that talk about the cyclical nature of where the economy is right now and those imbalances that occur as the business cycle moves.
Yes, exactly. And before I get skewered for saying all this, what I'm trying to do is spell out the way the Fed thinks about inflation rather than the way that you or I should think about it. Now, continuing on that theme.
And that's important because this is, from a control theory perspective, your analysis is talking about the reaction function of the Fed. So it's important to understand how they think about inflation, whether or not one agrees with it, because that is the basis that they're using for conducting monetary policy, adjusting interest rates, expanding, contracting the size of the balance sheet.
Exactly. So it's a bit like, as an investor, the viewership or everyone out there isn't in the position of watching a satellite land perfectly within 100 meters of target on Mars. Instead, what they're viewing are the hopeful but perhaps effective or ineffective attempts of an organization, a government-influenced organization, to control the path of the economy in a way that may or may not work. So we're actually observers of some process that may or may not work. But we need to know what the process is, and we need to know what the controls are before we can say anything meaningful about it, instead of having the conversation devolve into the Fed are idiots or the Fed governors are geniuses. I think that's a discussion I've heard a lot. I understand it. I get emotional about stuff too, but I don't think that that's the point that I want to make today. So, in any case, according to the Fed's view, monetary policy can affect this output gap, this trade-off between inflation and growth. And that's where it's directed. So if oil prices go from $50 a barrel to 120, and I believe that this is the Fed's model, if that's what I've inferred, then the Fed's not going to do anything about it, at least not short term. And they will apply words like transitory to it. If the output gap becomes a little bit punitive, in other words, if growth is above trend or employment is above target, more accurately, maybe the Fed does nothing again. They'll call it transitory, because they still think that as long as the confidence trick works, which is that corporates and retail believe that the Fed will ultimately control inflation, then they can continue putting that label on it, hoping that the trend will reverse.
Harry, you've got a really nice chart here called Likely Fed Model of Inflation that visually shows some of these points, the difference between long-term trend growth, the business cycle, and energy price cycle. Let's put that chart up there, and perhaps you could walk us through what we're seeing.
Well, the first is trend, inflation trend, again, which is supposedly tethered to inflation expectations. The second term is this output gap, or this Phillips curve trade-off between employment levels and inflation levels. And the final term is just kind of this sharply mean reverting random shock thing that has to do with oil prices. Now, this is stolen from the good people at nowcostingeconomics.com, based in London, so I thank them for that. Now, the crucial thing here is something that I think has been mentioned by other people, but I'd like to emphasize it again, which is that when inflation expectations become unanchored, then there's a problem. And if you look back as recently as May of this year, what you saw was that inflation expectations coming out of the University of Michigan came in at 5.3%, which I believe is the highest since the early 1980s. That can no longer be viewed as transitory inflation if you believe the Fed is thinking the way that we've spelled it out. So if they believe that the trend component is more meaningful than the other two, and that monetary policy really can only deal with the second component, kind of the economic cycle piece, they must have panicked at that point. So I think when expectations started to come in high, which didn't just happen in May, but it really was a significant number in May, that's when the imperative to act became strong. Again, are they doing the right thing or the wrong thing? No judgment there, no value judgment. It's just that if that's their model, they had to act quickly, or they felt they had to act quickly. But now they're faced with a serious problem. And this is kind of one of the main things I want to talk about today, which is that historically, if you look cross-sectionally over central bank interest rate policy, you'll find something interesting. Namely, that the time it takes to affect a growth, or affect GDP or output or employment, whatever, is less than the time it takes to temper inflation. So what does that mean in practical terms? It means that the Fed may have been taking a victory parade dance as growth stalled, but inflation was structurally low, for reasons that I can discuss, over the past few decades, simply because if they eased monetary policy, if they became more dovish, if they cut rates, if they expanded their balance sheet, they could stimulate growth more quickly than inflation would be affected. So in other words, they could get growth back to a reasonable level, they could stimulate the economy, they could free up the credit markets without triggering too much inflation, simply because the transmission lag between policy and growth is shorter than the transmission lag between policy and inflation.
Harry, I want to double click on this for our viewers because this is such an important point. This is what's new. This is what you're bringing to the table. Everything that we've just discussed up until this point is something that's fairly well known in macroeconomic circles, in market circles for people who follow macroeconomics. But Harry, this really is your key insight. This is the new piece. This is where the control theory comes in. This idea that these different policy objectives effectively happen on different time cycles, which creates significant problems, in fact, significant risks for the broader economy itself. Such a key point.
Yeah, I mean, the one point that I've left out is that when the Fed conducts policy, obviously they have a dual mandate, but they also have a loss function. The loss function is how far has growth moved away, let's say, from target growth, plus how far has inflation moved away from target inflation. So if they start hiking rates, then yes, inflation will come down eventually. I suppose they could always engineer a drop in aggregate demand or a drop in the availability of credit at a good price. But assuming that what I say is correct, that the delay is shorter, the transmission lag is shorter between smashing growth and tempering inflation, they're going to hit their loss function earlier than the market did think, probably 2 or 3 months ago.
Could you define loss function for folks who may not know?
It's a good question. In control theory, you're trying to achieve an objective at limited cost. So if I want to drive to New York from where I'm hanging out now, yeah, I'd like to get there quickly, but I don't want to spend too much by, burning through my gas tank or whatever the phrase is, by using too much energy along the way.
Right.
So there's a cost. And for the Fed, having read a lot of Fed documentation and other central bank documentation, there is a loss function. And the loss function basically says, how much pain is the Fed willing to take for its constituency in the process of conducting its monetary policy? So usually it's, or historically over the past few decades, it was how much can we cut rates without unleashing the inflation genie? Now it's turned on its head.
This is almost like the friction in the system, in a certain sense, that's lost. A dead weight loss, if you remember from your microeconomics textbook, those dead weight losses on supply and demand curves. This is the friction, the problem with the system that the control itself causes.
Absolutely. I mean, there are always these trade-offs. And the dual mandate has always been a very thorny thing. And yeah, I mean, that's kind of what we're talking about now. Now, if this all sounds a bit theoretical, but basically what we've tried to do so far has been to say, this is the way the Fed views inflation, namely the 3 different time horizon components. This is what the Fed is worried about, namely expectations becoming much higher than what the Fed wants. And this is what the Fed can control, namely this business cycle related component. We've also talked about the lags, and then we've talked about the loss function. And I think, although people were talking about this in January or February, I think I saw Alex Goreyevich talk about this before, that the pretty early, which was the Fed probably cannot continue on its hiking cycle without having to take a pause or actually reverse course, simply because of the damaging impacts politically or in terms of growth/employment that might occur. And the rest of the market probably has cottoned on to this. And if I were to throw up the slide that says changing rate expectations from the 10th of June of this year to the 23rd of June of this year, where the 23rd of June distribution is given in green, that shows it very clearly. Rate expectations have adjusted massively in the past few weeks.
Let's explain that, because this is a really important concept. What's happened here? What has the market sensed? And why have they repriced future interest rates?
Okay, now please correct me if I get too fancy, but I'll give it a shot. One good thing about the options markets is that you can back out investor expectations, not only for price, but also for a range of outcomes. So if there's a big bid in the market for the June 2023, which is the contract I'm interested in, and I'll explain why, for call options on Eurodollars in June 2023, what will happen is that the implied probability, what investors on aggregate think, is the probability of a rate cut or a rate stall going out 1 year will increase. And so what these options markets are telling you is what the market thinks, or what the options market thinks, is the true distribution of outcomes going forward. And if I had to boil it down, the main point is that as recently as 2 or 3 weeks ago, the market felt that going out 1 year, it was uncertain where rates would go. They might go a lot higher, they might go a lot lower. It looked pretty normal. And so what you saw in markets like equity markets and was a feeling that the VIX should be high, but tail risk was actually pretty low relative to the VIX simply because all outcomes were uncertain. Now what we're in is a phase where the distributions become pretty weird. A lot of people are banking or betting on the idea that the Fed will reverse course, maybe pretty quickly.
Right. And by reverse course, just to clarify for people who may not know, reversing course in this sense is withdrawing the normalization, meaning stop hiking so quickly because of the fears of recession.
Yeah, exactly. But at the same time, if you look at the graph, if you look at the green line, you'll see that the market thinks that or some people in the market have bid up the price of a 6 or 7% 3-month Fed funds rate going out 1 year. So the level of tail risk has actually increased. And I think this is an important point because a lot of people who have invested in deep out of the money protection strategies over the past year or over the past few months have been a little bit disappointed on average because the way that the market has traded down, now I'm kind of shifting to the S&P as a risk proxy, has been pretty orderly. And so you've seen various things, and I've got this in a slide which is called Implications for Risk Assets, where even though the VIX has been pretty high, which is a fear gauge, the level of steepness of the skew, which means the amount of demand for extreme event protection, actually isn't that high relative to the generalized level of fear, which basically means that investors were uncertain about all outcomes. And so there was a lot of uncertainty, but nothing loaded on the Armageddon event. Now what we're seeing is some pretty happy-looking Fed policy outcomes going out a year where, given that the target rate now is between 150 and 175 bips, where there's no change going out 1 year, and that's kind of tempered with the possibility of a tail event where they either hike radically or they cut close to zero. And I think the way that's going to play out for that investors should be concerned about is that we've been in a scenario where we've been in a kind of a standard garden variety bear market. Solid downtrends, lots of persistence, some reversals, but the reversals haven't been exceedingly strong, to something where maybe we'll have tail risk reemerge in its own way, simply because the amount of confidence that investors have in the interest rate markets that the Fed won't keep hiking may lead to a false sense of complacency in terms of market dynamics. So from a sort of a complex systems perspective, I think the range of normal outcomes has become tighter, but the tail has actually increased.
You know, Harry, these last 5 minutes here, this pivot, I think in many ways is why you are such a great guest, talking at the top of the show about macroeconomic data and then pivoting to market data. There are lots of guests who can come on and talk about one or the other. But as we talk about this market, this macro framework, and then pivoting to the CME data, to what you do every day, which is to look at derivatives markets and try and find things that are mispriced so that you can create opportunities or hedge. Talk a little bit about what you do and how it informs this work that you're presenting right now.
Well, I do a lot of hedging mandates, and a lot of them have been sort of downside hedges, and I've been acutely aware that the tail hedging component of the hedging mandates I've done, that component has done.
Let's define tail hedging for people who may not know.
Well, I had a recent interview where I said I don't even know what it means, but it means hedging against a really extreme event, a totally unanticipated extreme event. Maybe not a black swan, but anywhere ranging from a gray to a black swan. So what does that mean? Maybe a 10% down month in the S&P, 2.5 standard deviation, 1 month move in the market of your choice, be it a commodity or something else. And what we've seen this year, starting in January, has been a risk-off event that took a while to unfold. It was almost quite orderly based on a deterioration in macro conditions, a level of uncertainty about what the eventual outcome was, but flows that were out of risky assets in a fairly orderly way. That's not a tail event. I mean, a 20% move in a week is a tail event. I mean, that's open to debate. 20% move in 6 months down in the S&P perhaps is not a tail event. So really what we've seen is uncertainty that is very wide, but events that have not been entirely unexpected by the market, entirely unanticipated by the market. In the middle of all of this discussion, I wanted to alert you to 2 slides. The first one is basically a description of or a summary of the Fed funds futures curve over different maturities. So it sort of says where on average do investors think that the Fed funds rate will be from now to November of 2023. And what you see is kind of a dip going down to April, May, June of 2023, and then actually a rise. Even that is the sort of thing that as an investor you can find information content in. It suggests that the Fed is unlikely to keep raising rates indefinitely. And at some point there has to be a pause. And a crucial point here is that as recently as 2 or 3 weeks ago, the bottom point in the curve, in other words, the highest rate expectation point was June 2023. It's actually moved in a bit. It's moved in by a month or 2. So that's an illustration of the point that I made previously, that investors have cottoned on to the idea that the Fed cannot continue to hike at this sort of aggressive rate indefinitely without triggering a loss or a deficiency in growth. The other slide I wanted to emphasize was how all of this relates to risky assets, because I know a lot of you in the audience don't trade rates professionally. I mean, one thing that I've been doing a lot of recently has been trying to play the cycles of deflation risk fears, kind of recessionary risk fears and inflationary risk fears through the options markets in Europe, the US, and now Japan. But of course, many of you just trade the S&P. And what you'll find is if you look at the slide that says implication for risk assets, it sounds a bit fancy, what I've plotted here, but it's kind of just the ratio of how steep the skew is for S&P options to the level of the VIX. So basically, when the skew divided by the VIX is high, what it means is that investors are afraid of a tail event. They're worried that the market's just going to completely collapse. When the skew divided by VIX ratio is lower, what it means is that maybe investors are fearful about a wide range of outcomes, but they don't see the risk of a mega downside outcome as being unusually high, given the range of uncertainty that is currently out there. Now, it is true that in periods like March 2020, 2008 in October and so on, that this ratio went down, but it went down simply because the VIX exploded. So in 2008, it went to 80. In 2020, it went to a similar level. But now we don't have a super high VIX. We just have a moderately high one. And yet the skew is pretty flat. So until recently, what the market has basically been saying in equities land is that we don't know what's going to happen, but we don't think that extreme downside scenarios are any more likely than the general level of uncertainty would suggest. Now, I think with a certain amount of information baked into what people think interest rates will do, tail risk hedges may again be attractive. Now, I'm not trying to sell my book here now because I do a range of things, but I do like to observe the variations between demand for extreme out-of-the-money insurance and relative complacency, and I think that's a bit of what we're seeing now in the S&P, but we haven't seen it for a while. Now we're really seeing it.
Harry, as we walk through this thesis, obviously this is a very new theory, something that you've been working on here for the past few months in response to what's happening in markets. What are some of the risks, uncertainties, or limitations with this theory? In other words, where are some places that you think this might break down and why?
Well, the theory is based on my background in looking at equations with delays in them. And one thing that's kind of weird about equations that have lags is that if you move the lag a little bit, the outcomes can be very different. And so I'm making these strong statements about how the lag, the transmission lag for inflation is probably larger, much larger than the transmission lag for output, growth, or employment, as you see fit. We don't know exactly what the lags are. Even central bankers, Greenspan and others, I think even Milton Friedman said that lags are long and variable in one of his speeches. And given that we don't know exactly what the lags are, and given that we don't know how sensitive these inflation and output gap variables are to the lags, it's hard to quantify everything here. What I'm trying to say, really, my main point is kind of twofold. It's for the first one is conceptual, which is that it may be that the Fed cannot solve this problem. So if I lay it out as a proper mathematical formulation, it may be that there's no solution. There was a solution when inflation was low and growth needed to be pumped. Now there's no solution because inflation's high, growth cannot be trashed too badly, and growth gets hit first. The second point is, from a trading standpoint, how do you move back and forth between betting on Fed hikes and Fed pauses? I think this is a contrarian environment. Over what horizon can be debated. I think over multi-month horizons, we're in a contrarian environment where the Fed will try and react in a way that's probably a little bit behind the curve to whatever's going on in relative to the inflation picture, the leading indicator picture, which of course includes the shape of the yield curve and the S&P, among other things. And so what you're going to see is kind of the drunken sailor outcome at this point, which is the drunken sailor is trying to get back to his hotel, and he either walks too far to the left or too far to the right, trying to just walk in a straight line. And I think the lags, what lags really do, and this is the crucial point, is that they induce oscillations. If the lags are pretty pernicious, if they're bad, they induce overreactions in two directions. And I think that's what we're facing in the short to medium term. Overreactions in markets, whether it's the classical risk asset like the S&P 500 or more macro-oriented rates, I think we're going to see overreactions in both directions. And that's what investors need to be prepared for before they even consider what the end game is, managing that trajectory.
There's an old joke among statisticians that all models are wrong. Some models are useful. If you tried to come up with a model that was encountering every particular data point, you'd wind up like the old Jorge Luis Borges story with a map that was a scale of 1 to 1. It wouldn't be very useful. One of the simplifications you mentioned at the top of the show was excluding the Fed balance sheet, which obviously has run up to around $9 trillion. Some thoughts, Harry, on what potential error term that might introduce into the equation as you think these thoughts through?
Well, I've seen various people talk about trying to map Fed balance sheet changes onto implied rate changes. In other words, if the Fed cut their balance sheet by $1 trillion, what would that effectively be in rate movements? That's really hard to quantify. Obviously, it's another headwind. And as stuff rolls off, as stuff gets lower in value given yield increases. So in other words, if the Fed is holding treasuries and yields go up and the duration is long enough, then their balance sheet naturally goes down. If bonds mature or securities mature, their balance sheet naturally goes down. It's difficult to do that mapping. So I'm really focused for the time being on the rates component of this. All I can say is that the balance sheet component is an additional headwind because I can only imagine it's going to go down. And I really think we're at a crucial juncture because Fed statements are not going to mean as much as they did, especially given that inflation expectations are indicating that the Fed is suffering from a credibility crisis. And so we really have to look more at the data and more at the control system than we did previously, which makes the playing field a little bit different. I mean, previously the communications were hugely significant, and they were hugely significant because expectations could be tied to reality. As soon as that became untethered, we're now in a world of dealing with this overreaction function in both directions.
Harry, as always, a great conversation. We got to discuss some new models here before, things people will not have heard elsewhere. Final thoughts, key takeaways as we move to the conclusion of this conversation.
Yeah, I mean, we talked about a lot of things that are widely known, such as what the Fed's inflation model might be, what the key inputs are, namely inflation expectations, commodity price movements, and output gap or employment gap measures. But what many people haven't considered is the importance of lags, of the time it takes for the Fed to do something and for it to feed through into the economy. I think what we've discussed today is that the lag for tempering inflation is much longer potentially than the lag for modifying growth, which puts us in a position where the Fed is in a really tough spot, where if they push rates up too much or they cut the balance sheet too much, we're likely to go into a very deep recession, which will force them to reverse course. And given these lags and given my knowledge of how lags affect dynamics, what we have in front of us is a series of sharp oscillations, maybe wide oscillations, between risk assets outperforming hugely and yields backing up, and sort of recessionary shocks to the downside, similar to what we've seen, or worse, from January of this year to the present.
Harry Krishnan, always a pleasure to have you on Real Vision.
Yeah, likewise.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.